Hey folks, welcome back to the channel. And last week I put out a warning in the stock market that I did not believe the rally over the last couple of weeks was sustainable. I mentioned it was just a lot of buying for the fear of missing out, and that it looked like we might have reached a top. In the video, I looked at the SPY daily chart. I drew two lines and I said, it looks like the stock market will either follow this bullish trend line and go up in the next couple of weeks, or it's going to follow this bearish blue line and we're going to see a correction in the next couple of weeks. And how did that play out? Let's take a look at where stocks are now. It's not very clear, but it seems like we're following this bear trend line going downwards because the market closed on Friday at 408. So if you heeded my warning and didn't pile in like everyone else who was trying to FOMO into the market, then good for you. You can buy stocks today at a cheaper price than last week. Even though it is sloping downwards, right now it's not a clear picture because the stock market did not go down very aggressively. In fact, you can see there is a bottom wick to the Friday's market close, which is a bullish sign. So on Monday, I expect a green day, and depending on how strong that move is, we might break out of this bearish trend and the market could go up higher. Now, a big determining factor for next week of where the stock market is going to be CPI, and that's coming out on Tuesday, which is this line over here. So until we get clarification on whether the market is going down or if it's going up, there are a few opportunities elsewhere that I think we can look at that are quite interesting. And these would be more short-term trading opportunities than for long-term investing. So the first idea is to trade the VIX. This is the volatility index. When the VIX is high, it usually means there's a lot of volatility in the stock market. But when the VIX is low, like right now, there's a good chance the market is overbought. So I have a purple line here by 20, where the VIX is. And for the last year or so, you can see the VIX has been mostly trading between 20 and 30, with 20 being a relatively strong support. You can see it bounced off of here before, also over here, and it traded within a range around $20. So what's happening right now is that the VIX broke through 20 earlier this year and it kind of chopped around a little bit and now it's higher. So what I'm waiting for is a back test of 20, and if I turn on the exponential moving averages, you can see the green line is the 9-day EMA and the blue line is 21. I'm also waiting for the green line to cross above over the blue line. That is a bullish signal. And finally, the MACD, which is this blue line down here, it needs to cross over the signal line, which is this orange line. And that way, with all three of those criteria, I would feel confident going long the VIX. Now, the MACD is already above the orange line, so that's one criteria met. The green line is still below the blue line. It's getting there, but it hasn't crossed yet, so I'm waiting for that. And I'm waiting for a back test of this, because right now the VIX has had a nice run up, but it's coming down. So it's either got to bounce off of the green or the blue line, or it needs to bounce off of the 20 and continue higher. Because if it goes through the 21 and 9-day EMA, or it goes through this 20 line over here and continues going down, then this would be a fake breakout and I would not invest in the VIX. So there's still a few things that have to happen, but this is definitely something I'm watching very closely because the VIX does tend to trade in a range, and right now it is near the bottom of that range. So the next major move should be up. As you can see, it goes up, down, up, but I'm just waiting for some confirmation to be more certain that it's going to continue going up before I jump in. Now, how do you invest in the VIX? Well, there is an ETF, VIXY, the ProShares Trust VIX Futures, and this pretty much follows the VIX. There's another leveraged ETF, UVXY, but I think this one is better if you're just starting to trade the VIX because it's less volatile. And basically, this one follows the VIX, so I would do the same thing with this. The green line continues, and VIXY does this and continues going higher, then I'm going to buy right there. And I would get out of the position either if the ETF goes down and it crashes through the green line again, or it goes up above this level and starts to go down again. I would take some profits around there because that is a previous supply zone. So I think that's a trade that could play out very well over the next 1 or 2 months. Now, another trade that's quite interesting around the same time horizon is natural gas. Now, here's the price of natural gas. Right now, it's at about 2.5. The lowest that natural gas has gotten over the last 25 years is about 1.7. And as with any commodity, this is not like a stock. It can't go to zero. So although it can definitely fall to 1.7 again, I think that will be short-lived. And getting in at about 2.5 or $2 would be a pretty good risk to reward because eventually, if you believe natural gas is going to continue trading in this range of, let's say, between $8 and 175, then at some point you have to believe it's going to go back up to like $3 or $4 or $5 at least. So if you're willing to hold on to it, even if natural gas drops down to 1.7, then you're looking at a loss of about 30 or 40%. But on the upside, you can make 100% or 200% once the price of natural gas goes up again. We'll take a look at the 1-year charts so you can see the volatile price action of natural gas just over the last year. It went from a high of just under $10 to a low of 2.2 just last week. And the reason I'm interested in natural gas right now is because if we look closely here, this is almost a double bottom, which means this could be the price point where natural gas bounces and heads higher from here. Now, what's a good way to invest in natural gas? Well, you can use natural gas futures or future options. For example, here is the March contract for natural gas, and you can see the pricing here is very granular. But another way, and probably a simpler way, is to use a natural gas index fund like UNG, the United States Natural Gas Fund, and this basically just follows the price of natural gas. Once again, this is looking at a 1-year chart, and you can see it's been really high before, but now it's come all the way down here with a double bottom right here. So would I be buying this ETF right now because it does seem like it's at a low point? Well, I wouldn't buy in right now at today's price of 879 because if I draw a bear channel to show the price action over the last couple of months, you can see that we've had a breakout of this channel. But one single day of a breakout doesn't mean the trend is over. It could still fall further. And there's really no bullish signal unless natural gas starts trading above the 9 EMA, which is this green line over here. As you can see, over the last couple of months, it's always been trading below this green line. It managed to close just on it on Friday, but I need to see further confirmation that this line here is going to be support and that natural gas is going to come down, bounce, and head higher from there, which by then it should be over the green line. So if I were to trade this ETF, I would definitely wait and not make a move now. Similar to playing the VIX, I'm looking at the MACD. The blue line is over the orange line, so that's a positive. But the price has to be over the 9-day EMA green line. And ideally, the green line has to cross over the blue line, the 21 EMA. And that's probably not going to be for a while. But if I were to use options to trade this, then I can do things a little bit differently. If I look at the option chain for UNG, I can see that I don't have to buy it today at the current price. If I go to the March 17th expiration, which is about a month out, I can choose to sell a $7 strike. And for the benefit of making that $27, I'm going to take the risk of buying 100 shares of UNG for $7 per share on or before March 17th. So that means I need to have $700 set aside, but I'm making $27. So divide by 700 and then times 100 for percentage. This gives me 3.85% return in 34 days, which is not bad because it represents an annualized rate of return of about 46%. But let's see where $7 is. It's actually right here, which is quite a bit below today's current price. Now, to see why there was a breakout of the channel right here and not anywhere else leading up to this point, we have to zoom out a little bit and look at the price action from the past. And you can see right here in 2021, this is a pretty important line because there was a lot of support around here before. Until it goes in one direction and backtest the green EMA, we don't know if this is the bottom for natural gas in this cycle. But even if the market falls lower and it goes to like $6 or $5, being assigned the shares at $7 is better than buying it today at $8.79. And then if the price does go down there, then you can just sell another put option, maybe down around the $5 or even the $4 level. But the thing is, you want to scale into these and not just like invest your entire trading capital into this because it can definitely fall lower. However, the thing with these natural resource prices is that it can't really fall to zero. And even if it does, it'll just be a blip and it should bounce back up pretty strong because the cost of a resource can never be free. So those are a couple of asymmetric investment opportunities that I'm seeing where based on historical trends, if you use the indicators correctly and you don't get in too early, and right now for both of these trades, I suggest it's too early to get into them. But if you wait until the right situation comes up and you invest in these, there is a really good possibility you will catch the next wave up, whether it's UNG or VIXY, just because both have been beaten down so much lately. And not only that, but if the trade goes in your favor, you stand to make a lot more than a loss you would have if the market goes against you, simply because the stop loss is pretty tight, but the profits have a really long runway. For VIXY, you can see we can go all the way back up to around the 13.5 level before we meet any real resistance. So I will definitely be doing a video showing how I would go about doing these trades if I see all of my criteria line up. So make sure you're subscribed so you catch that video. But for now, these are just a couple of interesting trading ideas to keep an eye on. So thanks a lot for watching. I'll keep you guys posted if and when I make these trades, and I will talk to you in the next one.